Hey, if you're considering buying into a franchise business or starting a franchise business, stop and watch this video. Today, I'm going to compare starting a franchise or buying into a franchise with just starting a hard money lending business instead. So stick around, it should be interesting. Hey, if you're interested in the hard money lending business and you haven't, would you please hit the subscribe button and hit the bell icon so we can notify you every time a new video comes out? Thanks a lot. Hey, my name's Rodney Miller. I am a hard money lender located in Oklahoma City. I loan in Oklahoma and Texas, mostly the Dallas-Fort Worth metro. If you're interested in hard money lending, the business in general, or you're a borrower, want to borrow some money, then you've come to the right place. Let's get started. So the other day I drove by a strip mall near my house and noticed that one franchise was being torn apart and another franchise was about to go in. The new signs were up. It got me thinking about franchise opportunities. And this was I'll just say what it was. It was Chicken Salad Chick franchise that came in. I think it came in about it's probably about 18 months ago. And they spent a ton of money on the build out. I mean, they really went all out like they do in most of these these franchise locations. And they built the sucker out and they sold chicken salad for several months. And then I guess they went belly up and didn't make enough money and had to shut it down. And then it sat empty for a little while. And now another fried chicken franchise is coming in. It's the very end of the strip mall. But it got me thinking about franchise opportunities and franchise in general. And I thought I'd make a comparison to, starting a franchise with just starting a hard money lending business, just starting to loan money to people and make a comparison between the two. So what is a franchise? It's an agreement between a business owner, the franchisor, and another party, the franchisee. And it allows the franchisee to use the business name and all their intellectual property and their processes and systems. So they might be able to get a business off the ground faster and quicker than if you started something from scratch. So this is in exchange for some startup money, a fee, an ongoing fee, like a royalty fee, like a percentage of sales or whatever. And that's the agreement between the franchisee and the franchisor. So you've seen them. They're all over the place. We're talking about fast food, tax filing franchises where the guy's out there spinning the thing in the street, body shops, dry cleaning. There's all kinds of franchise opportunities. I don't know if it's most. I would guess that most of them require a brick and mortar space because a lot of them are food related or service related. So people will come to you for food or service or whatever. Now, according to the data from the Bureau of Labor Statistics, as reported by Fundura, approximately 20% of small businesses fail within the first year. And by the end of the second year, 30% of businesses will have failed. By the end of the fifth year, half will have failed. And by the end of the decade, only 30% of those original businesses will still be in place. That's a 70% failure rate. Now, franchisers are supposed to have a better success rate than that, but I've seen a lot go under recently. So I'm not really sure if that's the case. I went and looked at it, did a little research on the success rate of franchises, and there's very little data out there. I guess these guys don't really share their success and failure rates, and I wonder why. Now, I'm not a franchise expert. I've looked into a few over the years, and I actually did buy into one franchise, Homebesters, around 2003. Homebesters, I saw it on the billboards and stuff, looked into it, and that was a house buying franchise. You guys are all probably familiar with it. It's we buy the houses. And I stayed in it about a year, then I got out of it and went off on my own. I didn't really like the constricting nature of it. It was too corporate for me, too many rules, and I didn't like it. But it got me some training, got me on my feet, but it's a very expensive way to enter the house flipping business. So I think about that chicken franchise at the end of the strip mall near my house, and I see a lot of these things happen. And I just wonder, who's behind that? Was there some young couple or maybe an older couple that retired, took their nest egg, and then they buy into this franchise and they build out this space. It must have cost hundreds of thousands of dollars to build out the space and, are getting all this backing from a franchise and then 2 years into it, it just goes south. It doesn't work the way they were promised. And they are on the hook for probably a ton of money, the build out, the agreement that they signed with the franchise or they probably did not leave them in a good situation. And I think about people like that all the time because they're real people behind these franchises. And when they go under, and they put a ton of money in these things, they spend a lot of money for the training and for the the home office to come in and launch these things. You just wonder what kind of financial impact that had on these poor people that sunk all their money into these things. And then I think about my father back several years ago. He retired from an insurance company, and then he built a car wash, one of those little 6-bay car washes, and he sold it a few years later and had some money. He started a hard money lending business, and it was super easy. He just started loaning money. He needed a computer and a cell phone, and he was off to the races. And so those two things stuck in my mind over the years. And so I thought this would be a great video to compare the two: starting a franchise, loaning money. So let's look at franchising versus starting a hard money lending business. Let's make some comparisons. Let's use the food franchise. Now, the first two things we're going to cover deal with risk. As stated earlier, a franchise can be a very expensive opportunity to start. Yes, they're proven systems. Yes, you're having support from a home office and all that, but they're going to be financially and time-consuming ventures. So you're going to have a franchise fee, probably an upfront fee. You got to pay the franchisees, the franchisors, and then you're going to have a ongoing fee. Like I said, it's going to be 15% of gross revenue sales or whatever. They always take theirs off the top. It's not based on net usually, it's based on the gross sales. So big fee up front, and then you're going to have a ongoing fee as you make money. They're going to want a piece of that money. They're kind of your partner. Another expensive thing is build out. Like that chicken salad chick build out. I mean, they must have put a few $100,000 into this thing. You got a large build out if you're going to do a brick and mortar store. And, that is going to be a huge upfront cost. Employees, you're going to have to hire and train employees. And that's not cheap these days. Dealing with employees is getting very difficult. It's really difficult right now to find good employees. And then to keep the good employees after you have them trained, people start stealing away from you. But that's another really expensive part of starting a franchise is building your team, your employees. You're also going to probably need a marketing budget. When you start a franchise, they're going to want you to put into a bucket. There might be multiple franchisees in your area, and you put into a bucket usually, and then that bucket goes to billboards, television ads, radio, driving people to your business. So you're going to have that marketing budget that they're going to expect you to pony up on from the get-go. So basically, when you start a franchise, for the most part, you kind of dig yourself into a hole. You're going to be upside down. I remember when I did the Home Investors franchise, I was upside down for a couple $100,000 before I started digging out of it because we had a huge budget for television ads. We didn't have a lot of build out because we could work from our laptop, but they wanted to spend a lot of money in advertising. And I think I paid them a $50,000 or $75,000 upfront fee. And then they got $1,000 for every deal I did, plus all kinds of points and fees that went along with it. So with hard money loans, really all you need is a laptop or a desktop, a cell phone, and some business cards to get started. You don't need a lease because you really don't need a storefront. You can work out of your house. So you don't need to do build out. You don't need to sign any long-term contracts with potential partners or franchisors. And you really don't need any employees from the start. You can pretty much run everything by yourself and with people that you subcontract out to do little things like property appraisals, evaluations, and maybe a loan originator if you want to go that route. But they don't have to be employees. They can be part-time contract labor. So basically you could take the hundreds of thousands of dollars it might cost to open a chicken franchise and take that money and just start loaning it to people at rates of 15 to 20% interest and immediately start seeing cash flow. You see the beauty of that? The second part of the risk aspect is the long-term commitment. You're going to have long-term commitments when you start a franchise. You're going to have a long-term lease. So that chicken franchise that went out of business after 18 months, I bet they had a 5-year lease. And so they're going to be expected to pay that or make good on that. So that, and then the franchise parent company, probably they have a contract with those guys too, and it's probably not cheap to get out of. So you not only have all the upfront capital to get these things going, the ongoing commitment to pay the franchisor and the lease and all that, but also if things don't go well, you still owe some people for the lease contract and probably for your franchisor agreement. With hard money lending, you have none of that. You have no upfront commitments. You have no partners. You just start loaning money, and you can start small and you can grow as fast as you want. Hey, I got a question for you. If you were going to open a franchise business, or if you've looked into one, which franchise would you open, or did you want to open? I'd like to know that in the comments below. So the third point I want to make is you're going to have a partner with a franchise. It's going to come along with some strings attached. And yes, they're going to bring you good systems and processes and economies of scale for your purchasing and all that, and a proven track record, which will help you out. But it's also going to come with kind of a partnership. You're going to be in bed with these guys for a long period of time. The bad part is you're going to have some royalties. Like I mentioned earlier, you're going to have to pay them, a part of your gross revenues. And that's always, fun. But also you're going to be probably in a corporate-like environment. They're going to be telling you what to do. They're going to have really strict, rigid ways of doing business, and they're going to expect you to adhere to those rigid ways of doing business, and very little innovation, because they are a big corporation probably, and they're going to expect you to toe the line and do things their way. With the hard money lending business, you're kind of on your own. You're doing your own thing, and you're not having to partner up with anybody. Now, you might bring on investors at some point to help fund some of these deals, but that's not like having a partner. That's having like a co-investor in on a deal with you. You don't answer to them. You guys are kind of partners in a deal. Another thing with franchises is, see Subway sandwich shops, they're on every corner. Will they flood your market? I would always be worried about them flooding your market. Like if something's good and you're making a lot of money and it's doing well, they're going to know that. And they're probably going to consider putting another one in your area or several in your area. Because, let's face it, they'll make more money that way. So you always have to worry if they're going to take your little area that's doing really well and flood the market with other franchisees. My next point is scalability. I guess with a franchise, you could scale really fast because they have the good systems, processes, and support. So if you got one going pretty well, it'd probably be pretty easy to scale to another and then another and another. And that's one good positive thing about franchising. Their systems and processes probably allow you to scale a lot faster than if you started something from scratch. But I feel that same way with the lending business. The lending business, you can start off really small and you can just loan to a handful of investors, but it's super scalable. When you loan money, you can scale that business about as big as you want, as fast as you want, as long as you have the leads coming in. It's pretty easy to add employees if you need like a loan originator, if you need to have somebody go out there and do your marketing. You can add people to the mix like that, and they don't have to be employees. They can actually be subcontractors. I like to stay away from employees whenever I can. Another point I'd like to make is most franchises, I believe, are set up as owner-operator operations. Like you have to get in there and you got to work to make that thing profitable until you can scale it. I think once you could scale it, you could probably start moving into management, but you might have to have 4 or 5 locations to scale a franchise. In the beginning, you're going to be in there grinding it out, trying to break even, trying to pay off that big nut that you incurred when you started off with the build out. So most franchises in the beginning are owner operator. Like you're going to be in the business, working in the business, not on the business, because you're probably going to be digging out of a hole, like I said earlier, and the one location might not support you stepping back as the manager owner. You might have to work that business until you get 2, 3, 4 locations. And, at some point, I'm sure you'll be able to step back as an owner and work on your business. But I think initially with franchises, I think you're pretty much expected to get in there and grind it out. With the hard money lending business, you are the owner operator in the beginning, but you're not in a box grinding it out every day. You are probably sitting on your couch at your house, underwriting loans on your own time frame and doing it, when you want to, at the scale that you want to. It's a very, very low key, very easy business, and it's a lot of fun. So let's just cover some of those points again. Hard money lending is pretty simple business to start. You don't need employees. You don't need an office. You don't need any build out. You just start loaning that money. So let's just say you had $500,000 and you wanted to start a franchise. Well, you would put all that into the build out, the agreement, the upfront costs. You would sign a long-term lease. Or if you just went into hard money lending, you take that $500,000, keep it in the bank, and you start loaning it out at 15 to 20% interest. And that's it. That's your business. So let's recap. Franchises can be a very large undertaking, can cost you a lot of money up front and a lot of money ongoing. And they could come with a lot of risk, and in terms of signing long-term leases, long-term agreements, and big chunks of money for build out and upfront costs. Number two, franchises are a long-term commitment. You're making a long-term commitment with a lease and with a franchisor. Things go bad, you probably have to pony up. Number three, a franchise is a partnership. You're signing a long-term agreement with basically what's going to be your partner. And yes, they have good systems, but they can be very rigid in terms of the way they make you operate. They're going to want royalties on a regular basis, and there could be liability if things don't work out. You might owe them money. Number four, scalability. Both are scalable. Lending is easier to scale, I think, because you don't need you can pick a new location. You can pick another state, city, state, or whatever to operate in, learn that area, and then you can start loaning money there. You don't have to build out another building to scale your lending business. You just need to find another location and maybe some employees or some contract labor to help you spread some of the work, and you're good to go. Number five, you are the owner operator of a franchise, usually in the beginning. So you can do that. You can get up every morning and go make donuts, or you can do a hard money lending business, sit on your living room couch and underwrite loans. Hey, thanks for watching. We got a ton of free stuff down below. For borrowers, we have free reports, how to flip a house, how to guarantee a hard money loan. If you have a property you want us to look at, there's a link to our loan application down below. If you're an investor, we have a free co-investor brochure explaining our program. We pay 10% to our investors. If it's something you might be interested, check out that co-investor brochure or just give me a call and I'll tell you about our program. If you enjoyed this content, you might want to watch another video I have in here. It's how I underwrite hard money loans in 2023. You might find that interesting. And as always, please like and subscribe. We appreciate you. Leave a comment. Thanks a lot.